Alright, in this video we're going to take a look at a few spreads. We're going to take a look at a couple of calendar spreads and a couple of butterfly spreads, more complex, at the complex end of futures spreading. We're going to look at spreads in energies and spreads in grains. These are actual trades one of our new traders recently made and had a couple of issues with. So these are not beautiful textbook examples, but examples of trades when they didn't quite go as planned, and so we'll kind of have a look at why that might be and see what we can learn from it. So hope you enjoy. Okay, first up we're going to have a look at crude oil, and then we're going to look at natural gas, and then we'll get on to the grains. What we're looking at first up, this is a very specific or an exact trade. It's a bear spread in crude oil, selling December, buying January. Entered at the end of May, stopped out mid-June with a loss of $120 per spread. Let's have a look at this one. Now, if you've not seen this type of chart before, you probably haven't. This shows a seasonal trend, and that is a seasonal average, I should say. The red, I hope you can see the red and the blue on those charts. The red is the 5-year pattern, and the blue is the 15-year pattern, and the black line, the thicker black line, is the current or this year's spread. So the idea is that we can see the average pattern of this exact spread over the last 5 years and over the last 15 years, and we can kind of get an idea on what it can potentially do. As you can see from this one, this spread chops about for months leading up to the start of July, when it has potential to make a decent move. Okay, so we've entered this spread late May, stopped out early. I went and had a look at this spread. While it looks really good on paper, the numbers are kind of a bit all over the place, particularly leading up to about now. I've got their average profit of 410. That was the number I researched on the weekend. It's a few days since then, and I just went to look at where I got that from, and I couldn't find it. So I don't think it's a typo. I just looking at this spread, enter late June, early, the seasonal window is late June, exit early July. It's too short term for this kind of a spread. It's too tricky. That said, let's have a look at the market itself. So over here we've got, this is the December contract, and this is the January contract, and this is the spread for said trade. Now, let me see if I can zoom in on that for you. Okay, so that's the December contract, January contract, and that's the spread between the two. The interesting thing is, well, first of all, I think it's fair to say that this spread's never going to perform well while the market's rallying like this. So it's only going to show any good result if this trend stops. When will it do that? Yeah. Well, that's the $64 million question. And sometimes we can be helped along with this seasonal style data. But keep in mind, the seasonal data, think of it not as a trading system as much as an indicator. I see it as a very reliable, a very strong indicator, but you think of it, like an indicator, like a commitment of traders indicator or something like that. What I notice that's interesting on this spread is for the whole time the market's been rallying there, we've rallied from 56 bucks up to 70 bucks. The spread itself, is obviously rallying as well. But for the last, 6-7 sessions, the spread has started to, the spread's come back a little bit next to the market that's really kind of still at its highs. And that can often be, not always, but it can often be a good indicator of a reversal in the market overall. The spread starts to falter. The spread loses its momentum before the underlying market does. Doesn't always happen like that, but can. And so if anything, if we're looking for something positive out of this, then there could be a move in that spread now. As I said, there's the seasonal pattern again. It looks really good in July to me. That's one where you go, oh, what's, and you dig deeper. But when I did dig deeper, the numbers weren't that great for that particular spread. It got a bit choppy. You can see the 5-year pattern there in August, not looking that great. And then after that, it doesn't look very good at all. So if anything, this spread would be a directional play on the underlying market, and that is a directional play on crude oil without risking a heck of a lot. So trading the full-size contract, $1,000 barrel contract, $1,000 contract is can be very risky if you're trying to pick a top or whatever. You can do that and have a bit more of a chance of doing that and getting away with it, or having a slightly more forgiving position when you're looking at a bear spread like that. That's the kind of positive I can pick out of that. Natural gas, I've got natural gas markets along the bottom here. Okay, our trader said sold at 8.5, stopped at 9.5, which is $100 per spread. Entered it early as was following the seasonal pattern well until that day. Entered, Murphy's Law. Fair enough, that happens. To explain what a butterfly is, let me take a minute to explain that. And again, this looks like a really good on paper seasonal spread, but there are some things that aren't as what they appear. But let's have a look at that. So a butterfly spread is essentially a spread of two spreads. If we talk about a calendar spread, for example, April-May natural gas, creating a butterfly spread out of that would be then trading the May-June natural gas. So we've got April, May, June. In this particular instance, we're selling the April-May spread and selling and then buying the May-June spread. And that creates a position of one in the April, two in the May, and one in the June. Now, think of it as a spread of spreads. It is hard to get your head around what a butterfly is, what a condor is. Once we get into those more complex type spreads, it can be a bit, I meant to know this, but I still don't get it. It can be one of those kind of things. But don't think it's more complex than it is. This is a spread of a spread. Now, what is the single spread? Well, they are very directional positions in natural gas. So let's take a look at, let me get rid of that. Oops, there we go. So this is the underlying natural gas. This is the April contract. Now it's June, almost midnight here, but it's now the last day of June 2021. This is April next year. So you can see I can pull up any month. Now natural gas trades on monthly expiry, so you can pull up any month and it kind of looks like this, and it is being driven by the current heat wave in the US, as natural gas is often driven by weather. In fact, it's always driven by weather. So you can see the market's just boom, 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 ticking up. Can you see that there? Yeah, market's ticking up, kind of relentlessly. That's not going to be great for those spreads right now. Again, it's a bit like the crude oil trade, insofar as only a bit of relief in the underlying market will start seeing those spreads behave a little differently. Now, that butterfly, as I said, is a spread of two spreads. So here, let me zoom in again. Okay, so on the left side, or the first spread, if you like, we've got the April-May spread, and then on the other one, we've got the May-June spread. Now, they look really different, don't they? So you're not, the volatility, I've got the average true range for them here. The volatility is 4 times the amount on the front spread as it is on the back spread. And there's a reason for that. And that is those months for natural gas, what they call shoulder months, when the demand for natural gas, demand peaks in summer and winter, and is very kind of, I won't say next to nothing, but is in a lull in between those months, in the non-summer and winter months. So you don't tend to see a heck of a lot of volatility in those spreads there. So in a way, what you're trading right now, to be selling this first spread, to the April-May spread, that's currently 4 times the size or the volatility as the back spread. So in a way, a butterfly position is not that much hedged next to an outright position. Here's the butterfly here. See how it looks similar? It's funny that. I'll zoom in for you. There we go. I like this little zoom function. So that's the two-legged spread. This is the butterfly. What I wanted to point out as well in terms of getting in and out of this spread is we should always be using the exchange traded spread to get in and out. Let me call them up. So this is what I have here. I'm not doing that. Is quite often when you see analytics on future spreads, you'll see the price calculated as market A minus market B. But that's not necessarily the way we trade them. The way we trade them is to use what they call the exchange traded spread, and that's what we're looking at here. It's essentially a one-click entry, just like trading an underlying market. Instead of, let's say we're trading the April-May, to do it, I suppose, manually, you'd trade in the, you'd be selling the April, and then you'd go ahead and buy the May. With the exchange traded spread here, let me show you that one, we can see the spread market here. What you end up with in your account is each of those contracts. Right? You don't have a spread in your account, you have each of those contracts traded at specific prices. But what an exchange makes available is a spread market, which so essentially you can, the benefits are it's easier to enter a trade, but it's also things like managing your stops and your targets and your GTCs and all of that kind of stuff becomes so much more easier using these things. So it's a point I have to make, that I want to make over and over, because it's if you miss out on this, then you can open yourself up to a heck of a lot of slippage in trading these long-term positions. Understanding trading depth of market is not necessarily or a massively important skill when you're trading long-term positions, but certainly when you're entering and exiting, you need a way to do it. And this is the way that minimizes your slippage and helps manage your risk, manage your stops. Now in natural gas, they also have a market for the butterfly. So here we've got the market for, I'll go into the zoom thingy again, where is it? Okay, so here we've got a market for the two-legged spreads, but there's also a market for the butterfly. And you can see it's a whole lot thinner than these two. You can see there's a heck of a lot of depth here. It is, I think it's about 8 o'clock Chicago time. So it's pretty early in the morning, and there's still decent amount of depth. You get very tight spreads and very deep market here for the individual spreads, but bugger all for the butterfly. That's fine. You'll find that those orders in there are algos, and they're not going to jump around a heck of a lot, much more than what the outrights will, or the it's not outrights, but the two spreads. You can, for me, if I were trading this, I would probably try and leg it in each of those spreads. For me, if I was trading this, I would probably not worry about the butterfly. I'd just be trading that front month spread and running my stops there. That to me is an easier way of having what's really the same position. Pardon me. Because as I said, you've got here a spread that's not offering you a heck of a lot of exposure one way or the other. The volatility is really low. You've got your correlation here between that first spread and the butterfly is very high. It's basically, it's the same trade. So if anything, I'd probably be sticking with that one. You may be asking, what's that? That looks like a bad tick. It's not a bad tick. That is, I'll show you what that was. That was a spike up in the market yesterday. This is a, what's this, a 30-minute chart. So that's obviously weather-related spike some type of news related to that, I guess. That stuff happens, and that's what takes out stops and so on, unfortunately. Back to the trade. So entered the position early. Let's talk about that seasonal trend. Again, this chart shows a 15-year pattern, which is the blue line, and a 5-year pattern, which is the red line. So it kind of, when you first look at it, you think, wow, that looks great, that spread. But what you look closer, and even that 5-year pattern is not that exciting for the next few months. So there's a little upside in it in July, and there's potential downside in it in August and September if we were to rely specifically on that 5-year pattern. 15-year pattern looks a whole lot better, and there's good profit potential over the 15-year pattern. So it's still something worth looking at. With natural gas, what I tend to find is it's a game, the more than any other spread I can think of, even interest rates, where being patient can really pay off. And that is, if you're looking at a certain market, spreads trading at 9 points, put your bid in at 8, leave it as a GTC, good till cancelled, and then let it happen. If it happens, it happens. If it doesn't, it doesn't. So it's these things can be very dependent on the price you get. Also with natural gas, and this is not the case in this spread, I don't like trading something that's very close to expiry. That can pose a really big risk. As you can see later on, towards the end of this chart, you can see the volatility of the spread picks up, right? Well, that's because it's close to expiry. I've been caught out in that type of spread in natural gas before, being short the near month when some really cold weather hit the northern states, and the near month rallied and the back month didn't, and I'm stuck in a trade that was very tricky to get out of. But trading this far out of expiry, you're not going to have as much of that risk, although as we saw, this current weather pattern is affecting the market here. So and as I said, that's a September contract, but it's happening in the back months too, and that's why you're seeing it in that funny move in this spread here. Summary with that trade, there's still good potential in it, but be very patient, be very picky about the price you get for it, and your exact timing. Again, it's going to be, the only thing that's going to push that spread up is a reversal in that weather-induced pattern. So as soon as the market turns around, you'll see that spread spike, and shows, and that may well be timed with, our seasonal window there says early July, so we haven't even got to that point yet. So it's a few days away from that. So that being the case, a pullback in the market here after this big run up where everything's overbought, it might be timed quite well. So again, I appreciate how you've got into that trade already and been stopped out of it, but have a think about a re-entry, I'd say. Next up, let's do some grains. We've got 3 grain trades to go through. How long have I been around? 20 minutes. I'll try and make these a bit quicker. Let's look at wheat. Bought wheat at -7.5, still in trade, target 5. Well, I think it's about 7 now, so it's a little bit in profit, but not much. Seasonal pattern, our seasonal analysis says 14 out of 15-year winners, average profit 138, less than 3 cents. Enter early June, exit late June. I think that window's a bit too tight to be an exciting trade. And if you look at that seasonal pattern, particularly the red line, that stands out to me, that 5-year pattern stands out to me as this trade being counter trend. So you can see there from April through to, May, and then from July through to September, that spread is negative. That spread tends to fall, at least on the averages over the last 5 years, and to a lesser extent over the last 15. So buying this spread, as much as I kind of prefer bull spreads over bear spreads for some reason, I think that's a bit of a risky one. If you grab a little profit out of it, great, but don't rely on it for much more. Particularly since it's the closing of the end of that, it's the end of that seasonal window that we said, enter early June and exit late June. I don't think we need to look at the underlying markets here, but here they are anyway. Here are the two. December, January, and that's the spread between the two. Again, like the natural gas thing I pointed out, there is an exchange traded market, exchange traded spread for this market. So that's where you can place your stops, your GTC. Remember, with futures, a bit different from stocks or other things you might be trading, is that futures, if you place an order, it cancels at the end of the day by default. So if you want to leave an order in, you have to manually select GTC, good till cancelled. But you know, with spreads you can do that. You ought to be careful setting GTCs because people forget them too. But that's okay. We've all been there, done that. There's nothing, I don't think, too exciting to really elaborate on that trade. Soybean meal. This is a fun one. This is another butterfly. Again, let's not worry about these butterflies too much. They are spreads of spreads. So if we determine that a spread is directional, we have to work out how directional a spread of a spread is to get an idea of what the potential is for the trade. This one here, 14 out of the last 15 years have been winners. Enter early June and exit late July. Yeah, I think I've even written that as a typo. I reckon it's late June and early July. I don't like this trade at all. It's too tight. It's too close to the front month expiry, which is July. No, it's definitely a typo for that reason. So it must be exit early July, because you can see that on the chart here. I don't like it. It's too tight. It's too close to the front month expiry. You're just opening yourself up to, to me, that's going to the casino, and you might win, you might not, but that's too much of a risky trade. Bought back there, didn't lose a lot of money on that one. That's fine. Did not follow the seasonal trend at all. Fair enough. Just one thing on that. Again, you can. This is the. I'm doing things behind that one. Get rid of that one. Okay, so you can trade the butterfly just like the natural gas thing I pointed out. You can trade the butterfly. There is an exchange spread for that available. I'd make sure if you're doing that, if you happen to be trading a butterfly, again, not this one in particular, but make sure there's enough depth there for you to comfortably place orders. If we go back to I haven't got those ones pulled up, but if we go back to these natural gas, the depth here, you can see that the two-legged spread, there's plenty. You'll have full confidence placing GTC orders and going off to bed and leaving those running, because it's very rare for silly spikes to happen. But with depth like this in this spread, silly spikes happen. So again, we go back to was that the best way to enter to take the risk on that you wanted? And my view was no, I'd rather just be trading that single spread because it's highly correlated to the butterfly and you can manage your risk a whole lot better. Might be a little bit different with soy meal here, but beside, that's beside the point anyway, because I think that's way too close to expiry to be trading. That makes sense. All right, last trade. We're almost done. Soybean oil. Now, if you're not familiar with soybeans, I should just explain. Soybeans, little green things that make soy sauce and other stuff, they essentially produce two products. It's a bit like crude oil. Nobody uses a barrel of crude oil. It's the products that are made out of them that you use, your gasoline, your diesel oil, and your heating oil, and all of that. Soybeans are the same, and The process is called crushing. When they crush the little beans, oil comes out one end, and what they call soy meal comes out the other. Soy meal is used to make soy sauce and fermented things, as well as it's used as cattle feed. So that's the main use for it, I believe. So again, we've got a bear spread here. Okay, so we're selling December, buying January. Entered at 118, bought back at 74. Nice profit, good. But OFC, it went much further the next day. Shit happens. I can say that's my video. Yeah, shit happens. That's fine. It is entry mid-June, exit mid-July. So it's a 1 month seasonal trade. That's a nice one. And that entry there, entry mid-June. Yeah, that nice little consolidation down there was a great little place to enter. You can see here, again, you don't want to be holding it much longer. That 5-year pattern really kind of fades off from July onwards, although the 15-year looks great. Put more weight in the 5-year pattern than you do the 15-year, although that kind of doesn't make sense, but the 5 years closer to the current state of the market. So I always put more weight in the 5-year. That's kind of about it. Don't worry about that it went much further the next day. That stuff happens. Let me have a look at the underlying charts. Where are we? Soy meal, right in the middle here. No, soy oil, I beg your pardon. Look, there's nothing that jumps out there, I don't think. That's a good trade, and I wouldn't be too upset that it went much further the next day. That stuff happens all the time. Anyway, I'll put some closing credits on and we'll wind this up. See, I promised you I'd have closing credits. Please follow my videos on the YouTube thing and press the, follow, notification, subscribe, and the little bell, because it makes me happy. If you're interested in signing up for emails and things, either go to masterclasstrader.com, join our spread class, or just sign up for email notifications there, and I won't spam you because I don't care. All right, take care and trade well.